Hello everybody, it's Trisha Ghosh. I'm a mortgage banker and today I decided to do a video to help you understand the different mortgage loan types. So there's a lot of different loan programs out there, and so this is just a quick guide to explain the differences between the major ones. So getting started, I really just want to help you understand this. There's a lot of loan officers out there that are just, here you go, sign here, here's your loan, and they don't ever explain anything to you. So I really want to make sure that I'm matching the right loan product with the right client, that we're going to be able to meet your financial goals and take care of what's most important to you. Is it the monthly payment? Is it the interest rate? Is it how much cash to close you have? What's most important to you, and let's structure your loan appropriately and do the right loan program that is going to match those goals. And I'll also help make sure that you understand all of that too and what goes into it. So today we're going to talk about the three main types. We're going to talk about government loans, conventional loans, and jumbo loans. So government loans, these are FHA loans, VA loans, USDA loans, and they're all backed by the government. And so they really kind of target specific groups of people to help them fulfill the dream of home ownership. So FHA loans are really targeted for first-time home buyers and maybe somebody who has a little bit of a lower credit score and a lower down payment as well. Then VA loans are for our veterans. So veterans, active military, eligible spouses as well of military veterans. And then USDA loans are our rural properties. So there's specific areas that qualify for USDA loans. And then you also have to have an income under the income limit for those specific areas as well. So there's kind of two qualifications for a USDA loan. And the qualifications really, so on an FHA loan specifically, a lot of lenders will go down to 580 credit score. Some will only go down to a 620. Just depends on the individual lender. And usually about a 50% debt to income ratio, maybe up to a 56%. Just depends on the lender again. And for the FHA loans. And then VA, obviously you have to have eligibility to do that, and if you're a veteran, you should know whether you have that eligibility. And then USDA loans, again, is that low or moderate income for the specific area, and the property must be in that rural area as well. So pros and cons to government loans. On an FHA loan, the down payment that's required, the lowest down payment is a 3.5%, which is nice. And then a VA and a USDA loan, that's 0%. So you finance 100% of the purchase price. You just don't have a down payment. In those particular circumstances, you still have closing costs, but no actual down payment. And then easier qualification for those lower credit scores. And if you have any derogatory credit events like a bankruptcy or foreclosure in the past, the waiting periods for those are a lot shorter than some of the other loan programs that we'll go over today. And then lower interest rates as well. A lot of times the government loans just have a little bit of a lower interest rate than a conventional loan or even a jumbo loan. So the cons, there is mortgage insurance that's required for FHA and USDA loans, and it's not cancelable. So you have that for the life of the loan. On FHA loans, there's also an upfront mortgage insurance premium that gets added to the loan amount that you pay interest on every month. And so that's some cons there. And then USDA loans, you do have to be in those specific rural areas and be under the income maximum. And then VA, obviously it's only eligible military veterans and personnel that have that eligibility for that particular loan type. Okay, so let's talk about conventional loans now. So a conventional loan is a home loan that is backed by a government-sponsored entity. That's Fannie Mae or Freddie Mac. So they're the ones that set the guidelines and the rules that we have to follow. And by and far, Fannie Mae and Freddie Mac are very similar in the guidelines. There's just some subtle differences here and there that it's my job to know about. The qualifications here, you do need a 620 credit score. Sometimes you can get some better terms, or your interest rate is better the higher your credit score is. And you do need a down payment. Typically a 5% down payment is required, but if you are a low or moderate income borrower, for the area that you're purchasing in, then you only have to put down as little as 3%. And if you put down 20%, you do avoid the private mortgage insurance. So a debt to income ratio of 50% is typically about the highest that you're going to be able to go to. Anything under that would be great. And loan amounts, there is a limit to the conforming loan limits. And in 2025, that limit is $806,500. So as long as your loan amount is under that, not your purchase price, just the loan amount, then you can do a conforming loan. So some pros and cons to the conventional loan. The private mortgage insurance on this loan product is cancelable as long as you get enough equity in your property, usually about 22%. And if you have lived in the property or you've had the loan for at least 2 years. And there are flexible terms. You can do a fixed rate interest or you can do an adjustable rate mortgage. And if you put down at least 20%, then you wouldn't even have the private mortgage insurance. You don't have to start with that. Some of the cons, it is a little harder to qualify for the conventional loan. There's stricter credit scores and income requirements, and they're sometimes a higher interest rate, especially if you have a lower credit score. Okay, so moving on to jumbo loans. These are portfolio loans that exceed the conforming loan limit. So every year that limit changes. In 2025, the limit is $806,500. So as long as your loan amount is $1 over that, then you can get a jumbo loan. So the minimum credit score is a little higher on these even. So generally it's a 680 to maybe even a 700, depends on the investor. And they do require larger down payments. I think a lot of times it's a 10% down payment maybe. Sometimes there's some options that you can use, a second lien, things like that, to get it a little bit lower. And the debt to income ratio is lower as well. That's about 43% is the maximum that I've seen. Jumbo loans do differ per investor, and so each bank has different requirements. Each investor has different requirements that you have to fulfill to get that jumbo loan for that particular investor. So some pros and cons to jumbo loans. They do allow for financing of higher priced homes, and there's no mortgage insurance required for some investors, especially even those that you don't even put down a full 20%. The cons, there are a lot more restrictions a lot of times depending on the investor that you're doing the jumbo loan through. It does require a stronger credit profile and a higher credit score than some of the conventional or government loans do. So let's summarize all this. Government loans are great for first-time home buyers, our veterans, and those buying homes in rural areas with low or moderate income. And conventional loans are better for those, good credit, have a little down payment, just stable borrowers. And then jumbo loans are for borrowers that are looking to finance higher priced homes, just anything above that $806,500 level. So take action today. The best loan for you depends on your financial situation, your credit, your home buying goals, and what's most important to you. So talk to a trusted mortgage professional and explore what's going to make the difference in the different loan programs and what's going to make the most sense for you specifically. Make sure that loan professional is going to ask you questions like, how long are you going to live in the home? What's most important to you? Down payment, monthly payment, interest rate, and that way we can structure your loan and put you in the right loan product for what's going to make the most sense for you specifically. Thanks so much for watching. I'm here to help, and I'm Trisha Ghosh, a mortgage banker.